Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting. And welcome to Charts and Chat for August 8th of 2022. Please hear a disclaimer for important information. Well, we're going to start off with some of the big news from last week, which is obviously the non-farm payroll number for the month of July. You can see we've got two charts here showing you that we've essentially recovered the jobs that we lost in the pandemic. I see that large drop when the economy was shut down there in March and April of 2020, and you can see that the gradual clawback has resulted in a recovery essentially of all those jobs that had been lost. And you can see that it was a fairly dramatic number, something on the order of 22 million jobs that were lost. And the number last month was 528,000 jobs, and a rather strong number. Obviously gives a lot of fuel for the Fed to continue to raise interest rates fairly aggressively. But what it did is it brought us back to that break-even line. So again, recovered the jobs that were lost in the pandemic. However, there are now 600,000 people less in the workforce, which is an interesting development. You can see the unemployment rate on the right-hand side here. We can see the pandemic impact, soaring unemployment upwards of close to 15%, but now we're down to 3.5%. Which is, again, one of these massively generational lows here. Labor market in exceptionally strong shape. Again, very much not consistent with if you were in a recession, you wouldn't see these types of numbers. More information on the labor market. Here we've got labor force participation. And like I said here, the participation rate dropped, as you can see, during the pandemic, and has slowly recovered, but as you see that in the labor force, that blue line on the left-hand side chart, that has rolled over just a little bit. We saw participation just kind of wane ever so slightly. You can see that number now around 62%. You can see that before the pandemic hit, we were settling in around 63, maybe 63.5%. And so clearly there are people that are not in the workforce due to the events that transpired during the pandemic, and there are clearly more positions available for workers that want them. And you can see the employed number there in the green below that trending up and trending essentially in a very similar manner. On the right hand side, you can see where these jobs have gone. So, basically we've got professional technology services, transportation, warehousing. You think people that are giving up their jobs at, as you see down below, food services, and then they're taking jobs with Amazon, driving delivery trucks. And so you can see that clear transition here, and a lot of places, restaurants and other service industry folks are still struggling to find workers, and you can see that very clearly in this chart. Government employment is down, arts, entertainment, healthcare, social, healthcare business clearly impacted there, and you can see the upside on the top end of that chart, retail, trade, and then, as I mentioned, warehousing, transportation, technology, those areas seeing job growth. This is a really interesting chart, albeit a little bit busy. In that blue line, it shows you the federal funds target rate. So this is short-term interest rates. This is what we mean when we talk about the Fed changing interest rates. And you can see here in the area below the midline here, that represents economic contraction points. And almost always, let me underscore that, that you always see a Fed rate decrease when you see negative GDP. And obviously we've talked about over the last several weeks, having received that number at the end of July, that we are now in contraction for 2 straight quarters. And you can see that on the far right of this chart. But this is the oddity, that we're in an environment where the Fed is raising rates in the midst of an economic slowdown. And so I bring you this chart to just show you, if you go back to essentially 1970, that is almost never the case, that you are almost always reducing rates at the Federal Reserve when you see these periods of economic slowdown. So just underscore how unusual this environment is right now. Well, as we continue the analysis of the investment markets, here you can see the essentially the difference between the 2-year and the 10-year Treasury yield. And as we talk about the flattening and the subsequent inversion of the yield curve, that being that 2-year yields are higher actually than 10-year yields, that situation has become more acute. Now, the yield curve is now inverted by a tune of 30 basis points, or 0.3% here. You can see the transgression, I guess, of interest rates going back to 2010. You can see that the gradual decline in interest rates and the general flattening of the curve up through 2019. And we actually had a slight inversion in 2019. Of course, that was before the pandemic, and everyone's memory is a little blurred at that time, but it actually did foreshadow a recession, as I do think the current environment does as well. Now, in talking about recession, there was some really good research out by the Dallas Fed recently, which gives a lot of weight to the argument that we're not in a recession now. And I have waffled on that. The data is becoming much more clear on that point. But a couple of months ago, it wasn't as clear, and I thought that there was maybe a better than zero chance that maybe we were already in one and didn't realize it. But the fact is that there's several data points that typically factor into when the National Bureau of Economic Research's recession dating committee, the type of criteria that they look at in terms of how they analyze when recessions actually happen. There's just too many data points that factor into that aren't in that realm right now. And here are two of them right now. Non-farm payroll employment. You can see the December 21, December of last year was the peak in really the economic performance. And obviously that dovetails very loosely with our investment market decline here thus far in 2022. But you can see December 21 was the peak. If you look at employment exceptionally strong, and that is very inconsistent with a business cycle contraction, which is normally associated with recession. And you can see even the average going back to 1948 through 2008 business cycles, that where we are is just clearly not in that area now. And then you see industrial production is well above those post-peak trend lines, looking back at all of these different recessions over the course of really the better part of the last half century or so. We continue this analysis from the Dallas Fed. You can see household survey employment. Now, what we saw was just general employment on the last slide. Now we've got household survey. Again, very inconsistent with trend lines, very inconsistent with the long-term averages here. You look at manufacturing and trade sales, that is above the trend line. It's not outside the boundary. Neither of these on this chart are outside the boundary, but they are quite an anomaly. It would be the probability would be much lower that this would be consistent with a typical recession when you see that these long-term averages are much, much lower. And here we have real consumption and income. So this is something else I've been talking about quite a bit as well. So when you look at recessions, usually it's the dating committee for the NBER looks at gross domestic product, or GDP, which is what we generally call economic growth or contraction. But the other thing that's really important in that is gross domestic income, GDI, and you can see here real personal income, excluding transfers on the right-hand side, higher than our, at the upper bound of this trend line and well above that long-term average. So GDP and GDI combine to form GDO, which is gross domestic output. And that's generally much more of what the NBER is going to hang their hat on when they determine whether we're in a recession right now or not. So that, from that standpoint, GDI is very inconsistent with that. You can also see in the consumption line, that's well above the trend lines as well. And as we'll see later, there is a reason for consumption being a little bit higher that we should all be a little concerned about, but we'll talk about that here in a few slides. And finally, on the Dallas Fed research side, this is a composite of recession indicators. So this is, essentially the collective data points and their respective weighting scheme that the Dallas Fed has put together. And you can see that, after that zero mark, which is December of 2021, you can see that just on balance, there's just too many things going right for us to really be in a recession. Although, higher gas prices, higher food prices, certainly to a lot of consumers feel like they're in recession because their purchasing power has been completely eroded in really, literally just a handful of months. And that is being felt more so on the lower income cohort side than clearly in the upper income cohorts. But unemployment rate on the right-hand side, really, labor market is exceptionally strong. And so the bottom line here is when you have gross domestic income, consumption, production, and you have labor markets being this strong, you just don't see yourself in recession. Okay, as we transition away, I want to highlight quite a few other really interesting data points this week. So on the left-hand side, we've got essentially a container rate, Shanghai to Los Angeles, year-over-year change. I mean, we're down like almost 35% year over year in freight rates for container ships from Shanghai to Los Angeles. We do know that Chinese exports are moving higher and their trade surplus has expanded, but I think from China's perspective, and we do have some China charts coming up, it has much more to do with declining domestic consumption on the Chinese front, and that's why their trade surplus is so high. But here, good news is that container freight rates are moving down, which is a cost input into both the production and distribution channel for manufactured and processed goods. This is a good sign. So hopefully we can continue this trend line. You can see it does oscillate, so it's apt to perhaps move higher, but I think for the near term it's going to remain depressed and certainly down year over year. Now on the right-hand side, we see supply chain measures. We've got essentially in that blue line, which is unfilled orders, supplier deliveries. That's on the left-hand margin. And then in the black line, you have the producer price index and trade services year over year. And you can see that there's a loose but positive relationship between these two. And you can see that, when you advance this data on the unfilled orders and supplier deliveries about 8 months, you can see that PPI is very likely to fall. And that's pretty much what we've expected all along. And we already have seen a little bit of erosion there, but it's not become a critical point yet. But I think this type of trend line is consistent with the fact, or maybe consistent with the idea that we're not in a recession now, but that we're apt to head towards one in the future. Here's the ISM Manufacturing Purchasing Managers Index, and it's got an overlay of the overall index, which is in that dark line. And just as I mentioned in that last slide, we are trending down. We know that. It's very visible. It's well understood. And not terribly feared because these things are cyclical, and we know that we're in a cyclical downturn at the moment, driven by a lot of factors. And we do see new orders actually in contraction right now. So, and that's not a surprise either. I think we should not run for the hills or dig our head, put our head in the sand, but just, embrace this for what it is and recognize that we're in this cyclical change and, and begin to look forward to, what that next post-recession environment is going to look like and then begin to plan accordingly. Supply chain pressures, we see that these have been rolling over. So this is good. This is actually anti-inflationary. So this is the Global Supply Chain Index, Pressure Index, I should say. The Federal Reserve Bank of New York actually puts this data out. And you can see that despite the fact that it's it still is high in aggregate terms. It clearly has rolled over. And again, what we're looking for are signs that the inflationary input pressures are going down, and this is definitely one of them. One of the truly interesting things to have observed over the last several months is the profound change in the residential real estate market. And this is kind of a diffusion index, if you will, of the median price change for a single family home. And it's a 2-month change. And you can see that, this has oscillated quite a bit. But this goes back to 1964. And we cannot find a data point in this series, again, 1964, where we have had a greater 2-month decline in median prices for U.S. single-family homes. And right now, that data point over the last 2 months is about 12%. And just think about that this represents a median, which is that there are half of the observances where prices have gone down greater than that. So we're in a very unusual environment. So as strong as the residential real estate market was, and as ill affordable as houses were, not to say that their affordability is dramatically improved, but prices have come down quite a bit, and we've seen lots of cancellations. We see these are new home prices. We've also seen this quite a bit on the existing home sales, which account for a much greater percentage of overall home transactions. But you can see some of this due to maybe an easing in some of the commodity baskets that go into home construction. But a lot of it has to do with this whipsaw in demand due to higher increased affordability challenges. But as we'll see in a little bit, we've got mortgage rates coming down quite a bit in the wake of the 10-year Treasury moving down in anticipation of recession. Now, in the last slide, we saw the median change in prices for new home sales, and this chart here gives us existing home sales, but not necessarily in prices, but in units and activity. This is more of an index, and you've got existing home sales in the blue. You can see that those are trending down to underscore my point on the last chart about really how odd and tectonic this shift has been. So as strong as the market was, again, in 2020 and to some degree in 2021, so far this year, it's been completely the other story. So we've got in the white, you've got pending home sales, and then you have in the amber line, you've got an annual rate on total one-family houses sold. And so all of these are moving down at a fairly dramatic pace, and you usually don't see all of this moving in tandem. So it's very interesting what's going on in the residential real estate market right now. This chart really speaks to rents, and you can see that housing prices typically lead rents by about 9 to 12 months, and that seems fairly intuitive. So if you're a landlord and you're witnessing home price increases, value increases, your taxes are going up, and you're generally passing those along to your renters as their rental agreements are up for renewal. And so you see this typically work at a lag, and what's going on right now is certainly no exception to that. You can see this relationship working pretty strongly right now, with home prices moving up rather dramatically and remaining high, even though in the last couple of charts we showed where not only are prices coming down, activity is kind of slowing. So we do expect housing prices to roll over, but for the time being, rents are going to remain high and again work at that traditional lag. And so home renters are going to be challenged here for at least the next year. Well, with all that's been said about housing right now, the silver lining right now is that we've seen a 30-year fixed mortgage rate move down from 5.8 to just around 5. In fact, we eclipsed the 5% level, meaning moved below it for the first time since April. And you can see the dramatic rise that we've had this year. If you missed the boat in 20 and 21 on refinancing your home, Obviously, things have become a lot more expensive, but this is really due in large part to what's going on in the Treasury market. We talked about the inverted yield curve earlier, about the 2-year yields being higher than the 10-year yields, and we, were fairly close to 3.5% on a 10-year Treasury, and now that's clearly moved much lower, and so you see mortgage rates moving along with that, because that's where those those mortgage rates are indexed to. So that's a good news. Affordability is still challenged though, because aggregate rates are still much higher than they were. You can see here in this data series it goes back to 2008. I would expect the affordability question to remain somewhat troubled, but the market is easing, and that's the most important takeaway here. We'll talk about the labor market and where we are in the current cycle. Again, we're talking about some of these other indicators that are kind of portending or foreshadowing rather a recessionary environment. So here we have a change in U.S. job postings on the left-hand side. You've got total posting and new posting. And again, the data is not bad. It's flatlining, and it's beginning to trend a little bit lower, which is very consistent with heading into an economic downturn. We've had a couple of really strong years. Again, we understand that the labor market's exceptionally strong, and as we saw earlier, it provides explanatory power to the fact that we're not the premonition, I should say, not the fact, but the premonition that we're not in a recession right now, but we're perhaps heading towards one. And that data that you see on the left-hand side is consistent with that. Now, alongside that, we have on the right side, we've got the challenger U.S. job cut announcements, and you saw the notable spike there when we have the shutdown, and obviously people couldn't operate their businesses, so they were laying off left and right. Well, the labor market strengthened, and we reached a kind of a low point in those job cut announcements, but you could see that tail beginning to emerge. And so even though the aggregate number of job cut announcements that the Challenger survey here tracks it is below its multi-year trend line, going back to basically the 20th century here, that it is moving higher. So when you look at both of these in tandem, you can see that the labor market's strong, but it's beginning to tire a little bit in terms of its cycle durability. Continuing the theme on labor, something I've mentioned a lot lately has been this fact that we've got a tremendous number of job openings for every unemployed worker, and that's very much on display on the chart on the left here, data from the Labor Department. You can see before the pandemic, it's not uncommon to have more openings than there are people that are seeking work that are unemployed. However, that gap has never really been as wide as it is now. It's just very unusual. We know quit rates are still pretty high. We do know, and we saw here just in the prior set of charts, that job openings are beginning to roll over a little bit. We're in that cyclical downturn, that slow downturn in economic activity. So very consistent with the change in cycle, but the gap is still extraordinarily large. Now, understanding that there are people that are unemployed that were doing things other than what is, maybe some of the jobs that are now open for hire. But clearly that gap is just unusually large. Now on the right-hand side is what we call a beverage curve, cited often in economics, and I'll try to give you the layman's understanding is that you have a plot of data, and on the horizontal axis, x-axis, you've got the unemployment rate, and on the y-axis, the vertical axis, you have job opening rate, and these are both percentages. And so you can see that cluster of blue dots there. That represents all of the observations between December 2000 to March 2020. So when up until the shutdown of the economy due to the pandemic. Very tight relationship. So when you have a higher unemployment rate, that's typically associated with a much lower job openings rate. That pretty much makes sense, right? And so, and when you have a low unemployment, then you have a lot of job openings. And then the red lines, though, represent what we've seen after the shutdown. And there's a green dot up there that represents where we are now, which is, again, a very unusual spot. So we see extremely low unemployment. I mean, historically low unemployment, but we have a high job openings rate. And that ties directly over to that chart on the left, just how unusual this environment has been post-pandemic. Speaking a little bit about inflation and some of the inflationary impacts to the consumer right now, I've got several charts related to energy and utilities here. So let me just highlight first the one on the right. That just represents the U.S. consumer spending on energy, goods, and services as a share of all spending. And that has trended down on this time series that goes back to the 1950s. You can see overall the trend has been down. Obviously during the OPEC embargo and the ensuing inflationary period before Paul Volcker took office, that spiked considerably. And then we saw the latter half of last decade where that also spiked. But the general trend line is down, but it has moved up several percentage points. And so where we were about 3.5% of total spending, we're about 5% of total spending now. But that ties back to the two charts on the left. And the upper chart there represents a change in price from the end of December. So we know what's been going on in Ukraine and some of these areas. Crude prices, typically rally, when you have geopolitical tension, particularly in areas that are producers. And we know that Europe is in the process of kind of struggling to embargo Russian imported gas. That's one reason why you see that natural gas line spike really higher. But you see WTI, West Texas Intermediate crude oil that peaked in June and is beginning to roll over. Regular gasoline, which is a distillate from crude oil, you see that beginning to roll over. We know gas prices at the pump are down quite a bit from their peaks. And so you see diesel gasoline as well. So you do see some price relief there, even though natural gas prices are much, much higher. Now, going down to the lower left here, we see the average price of electricity to ultimate consumers. And we know that electrical generation comes from a lot of different sources, but the confluence of all of those sources is still driving prices higher for citizens or in the residential sector. It's also going up for the commercial sector, and this is kind of this part of the sticky inflation that's not apt to change. Even though prices at the pump are a little bit lower than they were, they're still a little bit higher than they've been. But electricity, as it were, you can see industrial, commercial, all sectors witnessing higher electrical prices. And this is just one part of that basket that we need to be cognizant of when we watch inflation. We'll look at this chart, Bloomberg Agricultural and Livestock Index, and this is overlaid with the CPI food consumed at home, and just the basically ag prices and livestock prices here in this chart are being advanced 8 months. So it's trying to foreshadow where CPI, the Consumer Price Index food basket, is going. And I think it's clear here, again, I love to talk about correlations and relationships, and there is a distinctly positive relationship between these two. And when you advance this 8 months, you can see that as ag prices, livestock prices are moving lower, and we know that they have been from their peaks, that you will tend to see a drop in inflation related to food items. And this is food consumed at home, so just think of the basket that you would buy if you go to the grocery store. That's what I'm talking about, which has been very high lately. But you can see here that the trend line is clearly that's going to roll over. Again, this is just one of these other data points, along with electricity that we looked at and energy that we looked at in the last slide. Food and energy are these two really volatile components that make up the all-in consumer price index. Now, they get stripped out when we talk about core prices, but I think clearly we're going going to see energy remain a little bit sticky, but it would expect to see that rollover. And here, I think it's clear that we're going to see an easing in food prices as well. Now we get to our China slides here, and as I mentioned, China been very much an enigma over the last year. Their zero tolerance policy related to COVID has resulted in a lot of haphazard economic shutdowns in various parts of their country, and we know that domestic consumption is way down. And so, as I mentioned before, China is exhibiting a pretty dramatic trade surplus now, and that's because they're producing more even with these shutdowns, but they're not consuming them at home, so they're having to push them abroad. And you can see here the official purchasing managers index on the left-hand side. These are, your manufacturing sector is actually, in this diffusion index, is actually in contraction. Non-manufacturing is not in contraction, but the latest set of data that we've seen is trending lower. Now you see producer and consumer price indexes on the right-hand side. And so, what's interesting in China is we haven't seen the inflation there that we've seen in the rest of the world, certainly not in the US, but a big reason why that is simply because the government controls the economy. And as much as China likes to think of itself as like an open free market economy, it is most certainly not. And so, there's subsidies for gasoline, there's subsidies for state champion, state-owned enterprises that, and also price curbs that are legislated from the Communist Party that keep CPI artificially low in China. You see PPI is rolling over. CPI is low, as I've mentioned, but it is moving higher, which is interesting. So here's some commodities, not all commodities, but and I thought this was pretty interesting. It was a chart in the Wall Street Journal that caught my interest, and obviously coal prices are up. Because during the interim, a lot of these areas, particularly in Europe, that have been shutting down nuclear power generation, are having to resort to coal because natural gas supplies are just a mere fraction of what they were. But I thought this plot was interesting. And you can see here in the headline, tough customer. We've had soybeans, cotton, copper, copper's an industrial metal that goes into home construction. All of those are lower than we saw at the beginning of the year, except for, I guess, soybeans, which is just really almost flat to the beginning of the year. But the invasion of Ukraine here has kept prices for coal much, much higher. Well, we want to talk about the consumer, and the two charts here that I think are pretty telling, and I foreshadowed these earlier in the presentation. But on the one hand, we've got personal savings that is now down to 5.1%. You can see this is a data series that goes back to 1990, so it's pretty telling here that savings rates spiked during the pandemic because of all these transfer payments, these stimulus checks that people got from the government. So savings was pretty high, particularly among the higher income cohorts, and those people generally just put it in the bank. People at the lower income levels were spending it, and but either way, looking at this in a broad stroke, that savings rates have come down, so consumption has remained high. We saw those in the Dallas Fed charts. Consumption's remained high, but in some measure because savings have come down. Now you see on the right-hand side, this is another one of these telling statistics. Both of these charts we need to pay close attention to, because the consumer does represent 2/3 of the economy. So on the one hand, we've got consumers that are drawing down their savings. On the right hand, you've got credit card balances that are moving higher, and then you also have increased in delinquencies for these credit card balances. So you've got this environment where consumers, and I'll make this note too, on the right hand chart, it's actually broken down by income quartile, which is particularly telling. You can see that that solid, or that darkest blue line there is delinquencies, credit card balances trending into delinquencies for the lowest 25% income folks. You can see that's moving higher at a much faster rate than the higher income cohorts. You can see there at the bottom in the non-blue line there that the income, the highest 25% in income earners, I mean, basically they're seeing no erosion in credit quality at all. So let's pay attention to this. So you've got lower income cohorts that are drawing down their savings. They're using more credit cards, and they're beginning to see increased delinquencies in credit cards. I would submit to you that this is still very consistent with an economic slowdown as people are trying to maintain their lifestyle that they were used to when they were getting stimulus checks. And at some point there is that day of reckoning where consumption is going to slow because of this. And so, I hope that the Fed is paying attention to this because this continued move to increase rates, when labor is exceptionally strong, I've got a feeling that it's going to have a fairly quick response, and you're going to see consumption begin to slow, in a pretty meaningful fashion. And I think at that point, once that's anticipated, I hope the Fed is clairvoyant enough to want to stall their rate increases. And right now, the consensus is that we'll get another strong rate increase in September, maybe a smaller one at that next meeting, which would be probably late October, I believe, because they're every 6 weeks, and then they'll kind of hit the pause button. And right now, there still is the expectation that we're going to see rate decreases next year. Here's the Consumer Price Index. 12-month change, we know inflation still remains high, ex food and energy. We see that there. We know food and energy has been high, but as we saw previously, I think energy remains sticky for a little bit, but eventually rolls over. And I do think food prices are already are really on the cusp of beginning to fall for us here. We'll switch gears here now and talk about the markets for just a little bit. Now, this is an overlay. I love these charts from Urian Timmer of Fidelity. They overlay in the black line the S&P 500 index. And what this chart is telling us is the earnings breadth and kind of the net positive or percentage positive 3-month change in earnings. And we see that is rolling over. This is not any kind of a surprise because we knew earnings were slowing up here and expected to continue to slow as we head into the remainder of the year. But you can see how that net balance, that we're down at negative 58% on our earnings breadth right now, that is corresponding with the kind of the rolling over in the index itself. Now, I expect earnings growth to continue to slow, but that doesn't necessarily mean that we're going to have a lot of contraction. I think it probably means more that that the market is going to remain flat and kind of choppy around a range, even though it has picked up a little bit lately. And here's a measure of breadth in the stock market. Obviously, we've had a little bit of a pickup lately, as we've talked about, and it's from a technical standpoint, it's good now that we see 77% of all stocks that are trading above their 200-day moving average. Earnings and margins. I think we're going to be talking a lot about this over the coming months, and you can see that we have operating margins rolling over. Not a lot, their peak here was 13.7. We're currently about 13.2% in margins, and you can see here that operating earnings are still moving higher, but they are decelerating. So earnings growth is slowing. We saw that a couple of charts ago. But this is one thing that's going to, I think, become a little bit clearer here in probably the third quarter results, and absolutely by the time we get to the fourth quarter results early next year. is that these lines are going to converge. So we're going to see earnings begin to track margins. I think this is one thing that we want to watch. Now, there are puts and takes here. Obviously, we were worried much more about margins several months ago because of the inflationary impact of input costs and things like that, labor costs, and the inability to put those through to the end customer and having to absorb margin hits. Well, that has played out to some degree, but some of those input costs, supply chain issues are beginning to ease, even though they're still somewhat challenging, particularly for some industries. But we do tend to see earnings and margins move together. And so if there's one thing that gives me some pause, it's this, and just making sure that as long as we have margins that kind of settle out, even though they're higher, you can see this trend line going back to 2006. So we're still at kind of stratospheric levels in terms of margins. So as long as the margins don't erode significantly further, I think the status of earnings is not too bad. That's all we have today. I hope you've enjoyed the chart pack. Have a wonderful week, and we'll talk to you again soon. Take care. Bye.